Stop looking at the red line on your screen. That number is not a value. It is a weapon. What we witnessed yesterday was not a market correction. It was a calculated, high-velocity demolition designed to trigger a specific psychological response: panic. If you are staring at your brokerage app, paralyzed by the sea of red, you are looking at a crime scene. But you are looking at the wrong evidence. While the digital price was being murdered in New York, the physical asset was being kidnapped. The 15% drop wasn't a liquidation of value. It was a clearance sale for the entities that actually run the world. We need to perform an immediate autopsy on the market. To the untrained eye, the last 24 hours look like chaos, a random collision of bad news and worse sentiment. But to a forensic analyst, this has the fingerprints of a controlled demolition. The floor didn't just fall out. The support beams were cut with surgical precision. We are standing at ground zero of a financial event that will be studied for decades, a moment where three structural failures converge to shatter the illusion of stability. First, we must dissect the liquidity vacuum that opened up in the East. The headlines will tell you that India sold off. That is a gross oversimplification. India is the lungs of the silver market. It breathes in physical metal and exhales liquidity. But yesterday, those lungs collapsed. Fearing regulatory shifts and import duty changes, the arbitrage desks in Mumbai dumped inventory in a panic. This created a massive chasm between the price in the East and the price in the West. Under normal circumstances, the arbitrage bots, the digital scavengers of the market, would step in to bridge that gap. They would buy low in one location and sell high in another, stabilizing the price. But yesterday, the bridge snapped. The volatility was so violent that the machine simply turned off. When the liquidity providers walk away, the price doesn't slide, it teleports. Then came the second blow, the regime change at the Federal Reserve. The algorithms that run modern finance do not care about nuance, they care about binary code. The nomination of a hawkish chair, a figurehead for a strong dollar, sent a shockwave to the high-frequency trading desks. The math is brutal and simple. A stronger dollar equals a weaker commodity price. Before a single human trader had finished their morning coffee, the machines had already decided that silver was the enemy. They initiated a short program not based on the fundamentals of supply and demand, but on a rigid line of code that prioritizes currency strength over asset reality. And finally, the trigger pull, the manufacturing data. The market was already bleeding, standing on a ledge, dizzy from the Indian sell-off and the dollar spike. When the data dropped, it didn't matter what the number was. It acted as a depth charge. It hunted down the stop-loss orders of every retail trader who was long on leverage. We call this a long squeeze cascade. Imagine a row of dominoes stretching for miles. The first domino falls, triggering a sell order, which lowers the price, which triggers the next domino. Within milliseconds, millions of paper ounces were vomited onto a market that had no buyers. But here's the detail that the mainstream narrative is hiding from you. While retail investors were puking their positions in terror, someone was on the other side of the trade. If you look deep into the volume profile, you see the signature of the giants. The bullion banks, the commercial entities that have been underwater on massive short positions, used your panic as their exit strategy. They didn't just cover their shorts. They swapped their paper debts for your physical assets. They shifted their books from net short to net long, effectively stealing the position from the weak hands at the absolute bottom of the chart. We are operating in a casino where the leverage ratio is over 300 to 1. For every 300 ounces of paper silver traded, there is only 1 ounce of physical metal in the vault to back it. When volatility strikes, that leverage becomes a guillotine. The margin clerks were the executioners yesterday. Traders who couldn't deposit cash fast enough saw their positions forcibly liquidated. This is a feedback loop of insolvency. It has nothing to do with the value of silver and everything to do with the mechanics of debt. So, when you see that massive red candle, do not interpret it as a loss of value. Interpret it as a transfer of title. The weak hands were washed out, the leveraged gamblers were destroyed, and the entities with the deepest pockets and the longest time horizons were waiting in the darkness with their baskets open, catching the falling knives without a scratch. We witnessed a structural reset. The paper market burned down so the physical market could be accumulated by the strong. To understand where we go next, we have to consult the ghosts of history. We are standing at a crossroads between two distinct timelines. Are we reliving the nightmare of 2011 or the opportunity of 2020? The bears want you to believe it's 2011. They want you to remember the margin hikes, the rule changes, the drive-by shooting that took silver from $50 down to the depths of a decade-long winter. They want you to believe the party is over. But the evidence points to a different ghost March 2020. Remember the panic? The world was shutting down, and silver crashed to $11. It looked like the end, but it was a fake out. That crash was a liquidity event, a desperate scramble for cash that washed out the leverage. From that bottom, the price rocketed. Why? Because the fundamentals hadn't changed. In fact, they had improved. We are seeing the same pattern today. The leverage has been flushed, but the demand drivers are stronger than they have ever been. This brings us to the geopolitical reality that the algorithm traders in New York are completely ignoring. We are witnessing the greatest migration of wealth in human history, moving from west to east. While New York trades paper promises, Shanghai trades the metal. The west is obsessed with the price. The east is obsessed with the ounces. The Shanghai Gold Exchange has been acting like a giant vacuum cleaner, sucking physical bars out of Western vaults. This is not a trade for profit. This is a trade for strategic dominance. China and the BRICS nations know that silver is the conductive vein of the modern economy. You cannot build the future without it. The Western hedge funds are panicked about interest rates, but the Eastern planners are looking at the supply chain for the next 10 years. They see a mathematical impossibility. They know that supply cannot meet demand. So when the price crashes on the COMEX, they don't panic. They celebrate. They view it as a discount on a strategic resource. The inventories in London and New York are draining. The metal is leaving the casino and entering private storage. This creates a coiled spring. The paper market can suppress the price for a while by printing infinite contracts, but they cannot print a single ounce of silver. Eventually, the paper market has to settle in physical metal. When the holders of those contracts stand for delivery and find the vault is empty because the metal is in Shanghai, the price discovery mechanism will shatter. Let's move from the geopolitical clouds down to the hard, cold ground of physical reality. If you looked at your screen yesterday, the computer told you silver was on sale, but try to buy it. Go ahead. Call a dealer. Try to buy a physical coin for the spot price you see on television. They will laugh at you. This is called decoupling. It is the moment when the map no longer matches the territory. Yesterday, while the paper price collapsed, the physical premiums exploded. The phones at bullion dealers were ringing off the hook. Why? Because industrial users and smart money know that you cannot print conductivity. The silver industry is devouring silver at a rate that was considered impossible 5 years ago. The new solar technology requires significantly more silver per unit. These manufacturers have production quotas. They don't stop buying because the chart looks ugly. They back up the truck and load up. Then there's the AI boom. We are building data centers that strain the global power grid. These servers require high-performance connectors. You don't use cheap substitutes in a $100,000 server. You use silver. And let's not forget the military-industrial complex. In a world of elevated tension, wars are fought with guided missiles and drones. A cruise missile contains kilograms of silver. When it explodes, that silver is vaporized. It is gone forever. The defense contractors are not day trading, they are stockpiling. On the supply side, the picture is bleak. We haven't found a major new primary silver mine in over a decade. Ore grades are collapsing. Most silver is a byproduct of mining other metals, which means the supply is inelastic. Even if the price went to $500, copper mines couldn't simply flip a switch to produce more silver. We have a market where demand is driven by government mandates and war price insensitive buyers and a supply chain that is stretched to the breaking point. So, yesterday's crash was a paper illusion. It was a derivative event that created a window of opportunity for industrial giants to secure inventory. If you hold physical silver, you hold the only asset that is simultaneously money, an industrial commodity, and a strategic defense material. The paper market can play games, but the factory needs the bar. The missile needs the contact. We are entering the repair phase. Markets are like wounded animals. They need time to heal. For the next 48 hours, we are watching 3 scenarios. The first is the dead cat bounce a weak rally on low volume. This is a trap. The institutions step back to let the price float up so they can short it again. Do not bite. The second scenario is the V-shaped squeeze. If the physical buyers continue to drain the vaults and premiums widen, the banks might flip long. If we break resistance on high volume, the bears who sold yesterday will be trapped, fueling a vertical rally. The third and most likely scenario is the grind. The market chops sideways, boring you to death, killing both bulls and bears who use leverage. This is designed to make you walk away. My advice is simple. If you hold physical metal, do nothing. You do not own a promise. You own the asset. The weight of the coin in your hand did not change yesterday. The chaos on the screen is noise. If you are a trader using leverage, you are gambling, not investing. The volatility is not over. We have more binary events approaching that could trigger another massive move. Watch the premiums. Do not look at the spot price. If the premium starts to drop, the physical market is relaxing. If the premium stays high, the stress is still in the system. Do not let the volatility shake you out of a generational asset. The paper price is a distraction. The transfer of wealth is the reality. Stay skeptical. Stay disciplined.